These discussions are for general information only and are not intended to provide specific advice or recommendations to any individual or organization. Work with your attorney or accounting or investment professional for specific individual advice and services. Any securities or investment products discussed on Talking Money are not insured by the FDIC, are not a deposit or other obligation of or guaranteed by any bank, and are subject to investment risk, including possible loss of principal not invested.
Good morning and welcome to another edition of Talking Money. This is Certified Financial Planner Professional Mike Miller. So glad you're with us today. Been talking about investing and trying to get some of the basics of investing out there. And so they'll be permanently on the podcasts and on our website so that we can have that to refer to, or you can have that to refer to later. As always, you can go to talkingmoneyradio.com. And that's where you can pick up the former programs that we've got. We're working on extending the number of programs that are available on that site with some compliance changes that we've had recently. We'll be able to do some more of that. So we're looking forward to that, and hopefully that'll be a big help to all of you for research and further information and educational, because that's what we're here for. We're trying to educate, and we want to answer your questions. You're live in the studio here on Wade Hampton Boulevard in Greenville, South Carolina. 877-235-9405 is the phone number, which we always love to hear from callers. And over the years, I've spoken to many, many listeners and also in the office, of course, but we'd love to hear you on the radio. If you're a little nervous about that, you can always send it as a text to 877-235-9405. Listening via podcast, of course, you won't be able to do that. You can send your money to your question. You can send your money to, but send your question to Mike at talkingmoneyradio.com, or go to the talkingmoneyradio.com website and click on Ask Mike a Question, and I'll be sure to look at that question and answer it on a future episode of Talking Money. So last week, if you missed it, we started having some basic conversations about investments. So I gave you some tricky investment questions, just some to help give you an idea how you might react in different kinds of situations. The first one had to do with what would you do if you bought an investment and just a short time after you bought it, it had the general market had a correction. It went down 14%. What would you do? Would you buy more of it? Would you hold on to it? Would you sell it? That kind of thing. The other question had to do with you've reached the $10,000 plateau in a game show. Would you keep going? Would you take the money and run? And I gave you several scenarios on that. We also talked about a common statement that I've heard over the years that I've been in the financial planning wealth management business is risk is fine with me as long as I don't lose anything. Well, and unfortunately that's why people look at risk is primarily with the volatility of the chance of losing money, as opposed to, in addition to that, you always need to be thinking of the other risks. I call them a stealth risk, because it's a risk that you don't see and it happens slowly over time, and that's the loss of purchasing power. And then I gave you a John Bogle quote, which had a lot jam-packed full of great information. It was just a couple of sentences where he said, overrating past performance is the most common mistake mutual fund investors make. And I have to add to that, and pretty much any other investment. It would even be true with real estate, any kind of investment, because it's just the way a lot of us are wired. Then he says, giving inadequate weight to risk, however you measure that risk, would be number 2, and being willing to shift funds too quickly would be number 3. And a lot of people listening buy real estate. You don't buy stocks, you don't buy bonds, and that's fine. But I think in real estate, you'd have the same type of mistake being made, people trying to move things too quickly, if real estate was priced by the minute, by the second, like stocks and bonds are. Now, the private credit and private equity is not priced by the minute. There's other negative issues with that, with the liquidity, but the hope, of course, is that over time you will more than make up with the lack of liquidity by a higher return. And just like with annuities, you're not going to have as high a return. Sorry, as much as they may tell you you're going to have a higher return, I've never seen it. And maybe it's out there, but I've never seen it. You're going for the safety on that. So the chances of you actually losing money, unless you get that money out early, then you've got a guaranteed, most annuities have a guaranteed loss for the first 7, 8, 9, 10 years as that surrender charge goes away. That's a guaranteed loss. So you factor that into your total return, because that's just part of how the return is calculated. Another thing we talked about was, what do the pros do? So we've had different comments from different investors, major investors that you've heard of, that talked about what they do and how they invest. So if you missed that, there you go. Back to TalkingMoneyRadio.com and listen to it. I think Tracy posted it yesterday. And then there's magazines. So you've got Forbes, Fortune's, Kiplinger's, you've got Money Magazine. And my caution there was to make sure that if you were going to buy a magazine like that, because you were looking at maybe some advertisements that they sent you or something else that you saw that gave an indication that they knew what they were doing and they could really help you decide how to invest next. So my encouragement there was to go back several years and pull out some old copies of whatever magazine, whatever newsletter, especially some of these newsletters that get put out there from these people. And I would stay away from anybody that sends you an email that has like a 45-minute narrative about why you should buy their newsletter. I mean,